Hi everybody. I want to talk about Chapter 3, Analyzing Your Company as part, and you can see on the screen there that the companies that have the best performing stock over the long run are almost always the ones that have a superior record of earnings, dividends, and improved financial condition. Now, we want to talk about, if I could just click this on, this whole chapter is about getting to know the company that you want to invest in. And one of the things you do is you go to the company's website and you can get the annual reports, the 10Q, the 10K, the annual reports and the quarterly reports, and brokerage security analysts investments and analyze them so you get to know the company. You can also you need to always get the income statement, the balance sheet, and the cash flow statement and analyze them. Now, all that information is available on websites like smartmoney.com, msnmoney.com, and Yahoo Finance. So you can get all the information about firms. Now, this slide's an interesting one. On trading, bulls make money, bears make money, pigs get slaughtered. And who are pigs? Well, they're greedy investors. They're ones that don't know what they're doing. And I've been there. I've done a lot of investing, and I've been successful, and I've also been slaughtered because I got greedy and I've had fear at times. But good, solid investors know their companies well, know their industries, and they have a strategy, and they have discipline, and that's critical. So anyway, you don't want to be a pig because usually pigs get slaughtered. Now on this slide, there's a lot of basic analysis that you have to do. ROE, return on equity, reinvestment rate, operating profit margin, pre-tax margins, capital structure, enterprise value, and all those, and earnings per share. And then there's a PEG ratio that's good. All those are good. And one of the things we're going to do in this next video, I've got a spreadsheet that I've got this company that our book has. It's called the XYZ Company, and there's an income statement for it, and a balance sheet, and a cash flow statement. And from those three statements, we're going to pick off and determine what's the ROE, the reinvestment rate, the operating margin, and all those good things. And I would like you to go to Chapter 3, and I would like you to understand those ratios and be able to apply them. Now, in conclusion, statistical concepts are important. Those ratios are important to understand. But also it's important, the author points out, is to know what the firm's primary business is, and is it an industry leader? I can't overemphasize that. I used to work for General Electric Company, and that's a conglomerate that has about 200 separate businesses. And Jack Welch, when he took over, he worked with the Boston Consulting Group to find a way to improve GE's performance. And one of the things the Boston Consulting Group pointed out is that the firms that have the largest market share in the industries that they're in, or in the markets that they're in, the firms that were number one and number two in each of those markets, they were almost invariably the most profitable, had the largest sales, and had the best cash flow. And they obviously, that's the reason they're number one and number two, because they got that way by their performance. But anyway, Jack Welch took that to heart. So if the businesses that the company GE was in, if they weren't number one and number two in their market, in their industry, he sold them, a lot of them. And they continued to work on improving it to get to be that way. And that was important. So I can't overemphasize that. It's important to understand who the principal competitors are and can they compete with them. Will the product prices be under pressure? And that talks about the strengths and weaknesses of management. So we need to understand all those as we go forward. Well, happy hunting, happy analysis. If I can turn this off now, I can find out how to do it.